If I had to start my day trading career all over again from scratch, I'd do it completely differently. Back in my early 20s, I wasted years of confusion, thousands of hours, and more money than I care to admit. The truth is, most of that pain could have been avoided if I had the right foundation. So in this video, I'm going to give you the exact blueprint I wish I had when I first started. A simple way to see the market, the essential tools you'll need, the psychology that will make or break you, how to keep risk under control, a crash course in technicals, how to build and test strategies, and finally, how to put it all together in real trades. Let's start simple. What is trading really? A chart is nothing more than human psychology drawn out. When demand is stronger than supply, price rises. When supply takes over, price falls. This constant back and forth creates volatility, and volatility is what gives us opportunity. As traders, our job is straightforward. We buy or sell at a price, risk a small fixed amount, and let the market move. That's it. Unlike investing, where you wait a whole year for 10–15% returns, traders zoom in on days, hours, or even minutes to find multiple opportunities. With the right process, $100 of controlled risk can create $300, $500 reward in a single session. But none of this works without the right tools. You need three things. First, TradingView. This is home base where you do all your charting and analysis. Second, a trading platform. If you trade crypto, you might use Bybit or Bluefin. For stocks, something like TopStep. Third, a trading journal. Trust me, this is the one most beginners skip. Without a record of your trades, you'll never know if you're improving or just spinning your wheels. Now let's talk psychology. This is the hardest part and the reason most traders fail. There are three beliefs you need to flip upside down. Number one, losing is not bad. In trading, small controlled losses are the ticket you pay to access future wins. Number two, being wrong is not bad. You can be wrong 7 out of 10 times and still end up profitable if your winners are larger than your losers. Number three, making money doesn't automatically mean it was a good trade. A good trade is one where you followed your process, sized your risk correctly, and stuck to your plan, period. Let's connect this to trading math. Imagine risking $100 on a trade. If you aim for 3 times that reward, your winners pay $300. Take 10 trades, lose 7, win 3, you lose $700, but your 3 winners make $900. Net result? You were wrong 70% of the time, yet you're still up $200. That's why trading is a game of math and process, not ego or perfection. So how do we read the charts to find those setups? I keep it simple. 3 tools. First, trendlines. Connect rising lows to spot an uptrend. Connect falling highs to spot a downtrend. Breaks and retests of these lines often signal big moves. Second, Fibonacci retracements. Pull from a swing low to a swing high and mark the 38%, 50%, and 61.8% levels. Markets love to retrace to these zones before continuing the trend. Third, fair value gaps. Those big single-direction candles that leave empty space on the chart. Price often revisits those gaps before moving again. When these factors line up, for example, a pullback to 61.8% inside a fair value gap with a trendline retest, you have what's called confluence. That's when probability is finally on your side. But tools aren't enough. You need to build an actual strategy. Here's the framework. Step 1, observe repeating patterns. Step 2, write a clear rule set. Entry, trigger, stop loss, take profit, risk per trade. Step 3, backtest. Use TradingView's bar replay to scroll through history, test your rules, and log the results. Step 4, track your data. After 5,100 trades, calculate your win rate, average win size, and average loss. If the math works, move to demo. If it still works, go live with small size. Execution matters. When I place trades, I always preset my stop loss and take profit. I never eyeball it. If my rule says risk $100, I calculate my position size to make sure a loss only costs me $100 no matter what. If I use leverage, it's only to scale my position appropriately, never to gamble bigger. Consistency is what scales small accounts into big ones. Here's an example. Price is in a downtrend, pulls back into a fair value gap, lines up with the 61.8 retracement, and forms a bearish candle. I short, place my stop just above the retracement, risk $100 and aim for a 3R target. If it hits, I bank $300. If it fails, I lose $100. One winner like that covers 3 losers. This is the math that makes trading sustainable. Of course, not every trade wins. You'll have losing streaks. The key is to keep risk per trade constant, review your journal, and adjust only based on real data, not emotion. Every loss is just the cost of doing business. Every win is proof your process works. Finally, let's talk about scaling. Once you prove your system over dozens of trades, you can increase your risk per trade from $50 to $100, $100 to $200, while the same math applies. That's how traders grow into consistent $1,000 to $3,000 days. Not from guessing, not from luck, but from repeating a process that stacks probabilities. So here's your blueprint. Keep your charts clean, use simple tools, respect risk, track your results, and never confuse luck with process. If this video helped you, hit like, subscribe, and share it with a friend who's ready to take trading seriously. And drop the word process in the comments so I know you're part of the group who's building this the right way.